The U.S. economy is teetering on the brink of collapse. When we take a look at real gross domestic product, however, which is the most common measure used to measure economic growth, we're seeing that the year-over-year growth in gross domestic product is growing. This is the red line here. However, when we take a look at an alternative measure of U.S. economic growth, measured here as real gross domestic income, we see a shocking change and a divergence that the economy has actually started to contract. Now, whether this contraction will hold on a year-over-year basis with real gross domestic income is largely irrelevant. What we're seeing here is the data telling two different stories. One segment of data is telling us that the economy is fine and strengthening. The other set of data is telling us that the economy is stagnant and weakening, threatening recession. Which data is correct? Well, unfortunately, when we look at the history of real gross domestic income and domestic product, they largely agreed with each other in growth rates. Though I will point out that in certain years leading up to a recession, real gross domestic income tended to precede real gross domestic product in deteriorating economic growth. In other words, real gross domestic income, RGDI, was a more sensitive indicator of impending recessions and a weakening economy than real gross domestic product, though not always. 2007 to 2008 was a huge lead up where it showed that RGDI was already contracting as soon and early as Q3 2007, while real GDP was still growing. And then that was the last time in history where we had this huge divergence in year-over-year growth between the two measures. And we're sort of seeing that play out now. While real GDP is starting to increase year over year, real GDI has diverged, is starting to decrease, and has actually entered negative territory. To confirm which statistic is going to be more accurate in predicting the U.S. economic status, we're going to have to look at a couple of other pieces of data. Now, the most common measure that I use to look at stability in the economy is loan performance data. So I look at the non-current rate, that is, how many loans have been delayed on payment status, and I look at the charge-off rate, which is how many loans have been actually defaulted. And I add the two rates together, and I compare that to gross domestic product. That's this blue line here, and what I have noticed is that for the last three recessions, whenever we see a year-over-year change in loan performance data, a degradation in loans, if an increase in defaults and delinquencies on loans by 40% or greater, the U.S. economy would enter a recession. We can see this here in 1990, in the year 2001, and then again in 2007, running up to the historic 2008 collapse. Well, where's the loan default data showing right now? Well, it's right now growing and increasing, but it's stuck here at 32% as of Q3 2023. We have not gotten Q4 data out, and we won't get that out till either February or March, to which I will most likely create an update to this video. So what I did is create a model that predicts the rise in delinquencies and defaults on loans. That's this red line, and the model has been very predictive for the last three economic recessions. Basically, whenever the model shows an increase of an indicator of 10 or higher, that is showing and indicating an increase in the delinquencies and default rates on loans. So it shows a degradation in the loan data. And this has been predictive for the last three economic recessions. And right now, the loan model, the default rate model, is showing that we should continue to see an increase in the degradation of loans. So loan default rates and delinquencies should continue to increase on a year-over-year basis based off this model. Now, the model's not perfect, but it has been predictive for the last three recessions. This loan model is hugely dependent upon Federal Reserve monetary policy, especially Federal Reserve federal funds rates. So if the federal funds rate decreases because the Fed decides to cut interest rates, that could then lower the model's indicator and create a sense of stability in loan data, or signal that a stability in loan data will generate. What this means is that if the Fed were able to cut interest rates soon enough, it could signal that the U.S. economy would indeed enter a soft landing. But that window for the Fed to cut interest rates and start expanding with monetary policy again, aka print money to buy debt and artificially lower those interest rates, that window of opportunity is decreasing and decreasing very quickly. In the next quarter or two, I expect that this loan default rate data to signal the next recession coming. When we take a look at the yield curve, which is in blue here, compared to the loan default data here in red, we also notice a strong correlation between a negative yield curve and the rise in delinquencies and defaults on loans. This has happened once again for the past 3 recessions, and we don't have loan default data going back to the early 1980s and 1970s to corroborate the yield curve then, but the yield curve on average has been very predictive of U.S. recessions going at least all the way back to the early 1960s. Now, what does the yield curve show with the current status of loan defaults? Well, the yield curve is negative, and you can see here the correlation between the negative yield curve and the increasing positive rising loan defaults and delinquencies data. When we take a look at stock market equities and debt securities that are bought through exchange-traded funds, which is measured by this value here of corporate equities compiled by the Federal Reserve Education Database in St. Louis, we are noticing a recovery in the stock market, but this itself does not signal that the U.S. economy is healthy. The U.S. economy stock market is actually in a huge, gigantic bubble fueled by excess debt, driven by low interest rates and 2 expansionary monetary policies. The last 2 stock bubbles collapsed, and when we compare that to 1 year's economic income measured as gross domestic product, when the last 2 bubbles collapsed, they largely corrected down to the gross domestic product level. In other words, theoretically here, by statistics, the stock market equity value should never exceed 1 year's economic income or gross domestic product. And what do we find here in corporate equities? They are overvalued compared to the stock market by over 2 to 1. And this is suggesting that there will be a catastrophic collapse during the next recession if the stock market were to correct all the way down to this gross domestic product level. The U.S. Federal Reserve may intervene in time before that collapse fully amalgamates, though I would suggest that historically speaking, whenever the collapse materializes and it was not instigated by the U.S. government, as in the case of COVID, but rather through a huge market failure, the Fed often reacts too late to stop the impending collapse as fear of doom and gloom sets in, and we see a mass sell-off in the stock market, correcting these overvalued equities down to this gross domestic product level. Taking a look at the non-performing loans compared to the U.S. stock market in history also shows that whenever we see a rise in loan default rates, suggested here in this blue line, we will soon see a correction in the U.S. stock market's valuations. And so this was the case back in the mid-1980s, as well as the late 1980s, leading up to the 1990 recession, as well as the correction leading into the 2000 recession, and as well as in 2008. So whenever we see these loan defaults reach about 40% or higher on a year-over-year basis, that tends to signal that the stock market has peaked and that we will see a correction down to this gross domestic product level. Now, I can't fully predict with absolute certainty that we're going to see the stock market chop by more than half, but it wouldn't surprise me if we did. However, the Federal Reserve's policy antics lately have been largely sensitive to stock corrections and swings in U.S. economic growth. So it is possible, though I would say unlikely, that if the Federal Reserve were to react quick enough, it could stave off the full correction. Nevertheless, I do expect to see a stock market correction. Now, when it comes to the yield curve and its negative status, it often happens to be about a year to 2 years out before the economic recession sets in, which is the case now. However, when we take a look at the non-performing loans tend to rise above 40% about a year out, or at least 6 months out, before the recession sets in. So we would have to see a confirmation in Q1 or Q2 of 2024 where loan delinquencies and loan defaults rise over the year-over-year 40% threshold to signal an economic recession in 2024. If this doesn't materialize, then more than likely the recession will hold off until about 2025 or later. Now, as I said before, it is possible that the U.S. Federal Reserve could achieve a soft landing. This was the case in the mid-1980s. Here, we saw an increase in loan defaults and delinquencies. Why? Because U.S. Federal Reserve policy with credit and debt was way too tight in the mid-1980s. However, Chairman Alan Greenspan then decided to lower interest rates, and when he did, he was able to stave off the economic bust completely, leading to a recession, though there was a correction in the stock market, at least until Federal Reserve policy was tightened during the late 80s, early 90s, which then signaled the coming economic recession. So it is very possible that if the Fed were to cut interest rates in the early part of 2024, they would stave off the recession at least temporarily, but they can never correct the economy and steer the economy correctly in the uncharted territories of economic waters for a sustained period of time. If the Fed chops interest rates and prints money to stave off an economic recession, they may be successful, but what they will end up doing is just creating more price inflation, to which will force them to have to tighten interest rates later on, which would then bring on the economic recession. So it's a case of now or a couple of years later, but it's not long off. But right now, the current model and the negative yield curve is signaling an impending recession in 2024. Guys, thank you for watching this video. If you like my content, please like, share the video, subscribe to my channel, click on that notification bell, and you'll be notified whenever I update you with a new video. And I most likely will in February and March on this particular topic when I get an update to this loan data. Once again, I thank you for watching this video, and I'll talk to you next time.